Myth number 4. The tax-deferred treatment of 401k plans means that investors will pay less in taxes. The tax-deferred treatment is often hailed as a benefit to plan participants. However, the fact is that the account is still taxed, although taxed at a later date. Proponents of 401k plans maintain that the effective tax rate for an individual is likely to be lower in their retirement years because their amount of income will decrease. This statement is questionable, however, because future income, just as anything else in life, is difficult to accurately predict. Even more unpredictable is the tax rate, which will apply 20 or 30 years from now. As tax rates tend to fluctuate significantly over time, the extent to which retirement funds will be taxed is simply unknown. As a result, you might pay less in taxes on a retirement account, but then again, you may end up paying more. Even if the effective tax rate does indeed drop, this may not be as advantageous as it seems. This can clearly be illustrated with an example. Let's assume for a moment that the effective tax rate for a 45-year-old individual is 35%. Let's also assume that this rate drops to 15% at 65 years of age. In this simplified example, this amounts to a 20% difference over 20 years. In other words, the decision to hold funds in a 401k for 20 years produced a 20% return over the life of the investment, which amounts to just 1% per year when considering only taxes. This 1% annual benefit raises an important question. How are plan participants being compensated for dealing with the limited liquidity of their 401k? As you would typically be charged a 10% penalty in addition to paying taxes on the withdrawal of funds from your 401k before reaching a certain age, the accounts are therefore relatively illiquid and limited in their possible benefit to the plan participant. This illiquidity carries increased risk because your money may not be available for you when you need it, which typically calls for a higher return to be provided to the investor. This higher return, however, is not made available to 401k participants. Instead, participants are left to simply accept whatever the market produces for them, including losses incurred by the limited selection of funds made available within their plan. So as you can see, even when assuming that the effective tax rate is substantially lower in retirement years, it is evident that the benefit to the individual is marginal despite the advantages constantly being hailed by the financial industry. In addition, investors should be asking how they are being compensated for the limited selection available to them in their 401k plans. When evaluating investments, investors typically demand higher returns when their options are limited or when they face restrictions related to a particular investment. However, this is another factor missing from 401k plans. Additionally, the high fees charged by many 401k funds can significantly erode investor returns over time, leaving even less money for retirement. Myth number 5. 401k plans are most beneficial to the individuals investing in them. The obvious winners are the plan administrators, employers, and the mutual fund companies whose funds are featured in 401k plans. As mentioned earlier, employers are enjoying the lower costs involved with providing 401ks instead of pensions. As for the mutual fund companies, they are benefiting because their products are exposed to a captive audience for many years at a time. There are often few options available for plan participants, and as such, mutual fund companies do not need to allocate substantial resources to managing these funds, as investors are usually unable to withdraw their money anyway. In cases where an investor does sell shares of a particular fund, the investor may unknowingly transfer the money to another fund issued by the same mutual fund company. This changes little since the same company will collect fees regardless of which fund the individual chooses. In the end, there's often just one winner in such circumstances, and it's unfortunately not the investor. Plan administrators are also benefiting from the established 401k system as they receive payments made by the mutual fund companies which seek inclusion into the plan. The plan administrator also collects administrative fees from the plan participants. As is the case with the limited selection of mutual funds available to employees, the choice of plan administrator is usually not a choice at all. As a result, plan participants must accept and pay whatever fees are charged by their particular plan administrator. Perhaps the biggest contributor to the success that plan providers and mutual fund companies have enjoyed relating to 401k plans is the mentality that Americans have regarding their retirement accounts. Participants typically consider the 401k as an investment with a faraway target date that does not need to be actively considered or carefully managed. Instead of utilizing the constant monitoring and risk management necessary to achieve success in investing, participants typically apply an overly passive buy and hold perspective, which can lead to disappointing investment results and inadequate income in retirement. This is particularly troubling given the time and care usually allocated to making other, less financially critical decisions, such as choosing which car to buy or planning a vacation. So what can investors do as an alternative to investing in a traditional 401k plan? When considering the restrictions, limits, complexity, and lack of transparency associated with 401ks, it becomes clear that there are inherent pitfalls which contrast the stellar benefits touted by the financial services industry. However, plan participants seeking a better alternative are advised not to simply withdraw funds from their plan, as this may trigger significant tax consequences as well as a 10% penalty if funds are withdrawn before the participant reaches a certain age. In order to enjoy more freedom and control over their finances, investors should consider the alternatives before contributing funds to tax-deferred accounts. As these accounts are typically invested in the stock market through mutual funds or annuities, investors may be better served by making the same investments on their own and without the 401k plan acting as an expensive and restrictive intermediary. With the abundance of investment options currently available, investors are urged to seek the help of a qualified, experienced, and trusted financial professional to guide them through the markets and assist them in finding the best investment options available, whether or not they invest through a 401k plan. If you have any questions about your investment situation, you should contact Athelon Wealth Management today. As an independent, fee-only registered investment advisor, we refuse to accept any commissions, referral fees, or other third-party incentives of any kind. This allows us to provide investment management services without conflicts of interest. Call us today at 347-706-1414 for a free introductory consultation with a qualified and knowledgeable investment advisor. You may also visit us on the web at athelonwealth.com for more information. That's ATHELON Wealth.com. Once again, this is Alex Efros. Thanks for watching.